Hi guys, I wanted to make a quick video because with markets hitting highs again and the backdrop of the pandemic, there is a little bit of uneasiness as to whether this is another bubble that we're coming into. Time and time again, we're hearing that in the market, and that combines with that FOMO mindset, that fear of missing out. So in this video, with interest rates as low as they are right now, there is a case that stocks are not as pricey as they seem, but there is also better investment options. So let's get straight into it. Now, as you know me by now, or do you, when I invest in stocks, I use checklists, and checklists help with sorting out the riff from the raff and help you also focus in on shares that meet certain characteristics that you're looking for when stock picking, and also eliminates that emotional risk, be it income, growth, or value, or quality shares. Some of the items on my checklist include ratios, and I tend to focus my picks in two areas, and that's growth and dividends. So I have recently collabed with trading with CJ, and he will put my dividend checklist on his channel, so go check it out while you're hanging around. One of my favorite ratios I do want to talk about is for picking quality value stock, and that is referred to as CAPE, and this stands for cyclically adjusted PE ratio. This jargon, honestly, but let's go back to basics. What is a PE ratio? A standard PE ratio is one of the fundamental ratios for judging if a stock is cheap or not. It's also very simple to work out, and as you know, we like simple things around here on this channel. Keep it simple. PE ratio itself is simply the earnings per share minus the profit you own per share that you buy divided by the share price, and that's all nice and easy. It's very nice. But the key point is that the lower the PE ratio, the cheaper the share, technically. Having said that, a low PE share does not mean it represents good value. It can also point out issues or concerns that investors have. So for instance, a stock could be cheap because investors don't really feel that the company can maintain its current earnings, or likewise, a stock can be expensive because investors feel that the company will continue to grow. Just doing that review of the PE in isolation shouldn't really dictate how you buy or not. However, when you use it as a comparison between, say, companies in the same sector, it is quite a nice tool to see how investors feel about, and also to build that contrarian hypothesis. Going back to that CAPE then, there are companies by the nature of the industries which are cyclical. So for example, house builders, they have economic cycles. There is also periods of growth and expansion, and other periods where, for instance, they won't really be as profitable and trade on lower PE multiples. In these instances, we use CAPE, which helps correct PE ratios over time, and that is it. As an investor then, it can also be really helpful. Identify when those shares are cheap compared to the industry. In this video, we can show how CAPE can illustrate how expensive that market really is. Now, the CAPE theory was actually devised by a really smart chap called Professor Robert Schiller, or Skiller. Schiller? Sorry, I'm the worst when it comes to name pronunciations, and he isn't in front of me for me to just check. But going back to this, it is similar to a PE ratio in that it looks at how much an investor pays for earnings, and it does this over a 10-year period. And I like that because that irons out any fluctuations in the business cycle. Now, the reason why CAPE itself is so amazing and smart is that in history it's shown that buying an index when the CAPE is low delivers the best returns rather than buying when the CAPE is high. It does make sense, however, it goes against that age-old adage of don't time the market. It also applies to the CAPE where in recent years, for example, the CAPE hasn't been working. For instance, the S&P 500 looks very high on the CAPE scale and has looked overvalued for many years. And not just on CAPE, but on a raft of other measures as well, but it keeps on climbing. An investor using CAPE-based analysis won't really have done well, and as we have seen, many value investors have not done well at all. But the question is, why? Why didn't they do well? And to be honest, the simple answer to that is down to interest rates, which have never been this low before. With interest rates being low, basic economics tells us that asset prices should be high, and this is a bit of a mind bender, but it's because future income streams become more valuable to investors today. And we see this play out very simply in the housing market, where investors would favor real estate when rates are so low, as it makes income income from property way more attractive, guys. But then what's the point, and how can we even use CAPE in this low interest environment? And from the research I found, you have to kind of invert it. Inverting it, we express the CAPE as a yield, and then we can compare it with real rates of return in the bond market and with inflation. In the US, the ECY is around 5% a year, and that's adjusting for inflation. The higher the ECY, the better it is. And so 5% historically for 10 years is good. And that makes the US attractive and even more interesting, as we expect all those low rates to continue with central banks behaving the way they will be. And if you are interested in that, then I would urge you to go and check my other video out on the Roaring 20s. I do have to say that other regions are even cheaper. For instance, the Eurozone and Japan are trading at 6%, while the UK is more like 10%. And in fact, the UK is the only major market where it still remains well below pre-pandemic levels, and the long-term average is making it very cheap with a good margin of safety. Good deal, Britain. As they say, all roads lead to Rome. And I do think the main nugget of information, if you do take anything away, is that actually when people say the markets are overvalued or the world is too expensive, it really isn't. It's a tough time in the world for all of us. And yes, industries are suffering, but as an investor, we should stay the course and ride that wave by investing consistently and also being well diversified, because that will continue to pay well. And nothing I see at the moment points to the contrary, even if the bumps on the road make you sick sometimes. Who gets travel sick? I haven't recently, but I have had times where I have. Either way, why is that information useful? But here are a few videos which cover some of those basic principles of investing in the market, like dollar or pound cost averaging and inflation. And also check out my video on the Roaring 20s, like I mentioned, which I'll pop a link down below. See you there, guys.